Hi, we will look at traditional assets such as gold or the S&P 500 to be seen over here, or the Nasdaq. We will look at historical charts and we will compare those asset classes. So for example, over here what you see is the Nasdaq divided by the S&P 500. Or what you've got over here is the gold price divided by the S&P 500. And I find these relative charts quite interesting because if you only look at, say, the gold price chart, of course, over the long term, if you look at like 25 or 50 years, it goes up. If you look at the S&P 500, it goes up. If you look at the Nasdaq, same thing. But what's really interesting is actually how do those assets perform relative to each other? Is there a way to spot certain trends, to change asset allocations, to maybe also make some conclusive thoughts about gold? Does it make sense to buy gold now? Because we're basically at similar levels to, say, 10 years ago, right? Isn't it still relatively cheap given that there's so much money printing happening and given that there isn't as much hype around the asset compared to big tech or compared to Bitcoin? Now let's look first at the gold price divided by the S&P 500 chart. And I think this chart is interesting since August 71. So basically since that point over here. And why is that? Because that's when the Bretton Woods system fell, right? That's basically when the dollar was not anymore directly exchangeable for gold. So the dollar became a real fiat currency, a currency that wasn't backed by anything literal. There was no real fixed exchange rate to anything. And so when you look at this gold chart over here compared to the S&P 500, we can see that once Bretton Woods fell, the gold price went up. It shot through the roof. And this rally lasted around 10 years, a bit less than 10 years. And the gold price grew relative to stocks by by more than 14x. So that's pretty impressive, right? There was this big rally, the great fear that fiat will become worthless, and that fear translated directly into gold purchases. And interestingly enough, not as much into stock purchases. Because one could argue that stocks might protect you against regular inflation in a similar matter, right? If general prices rise, companies can just go with the flow and their profits will grow with inflation, right? If you've got stocks, you're basically hedged against moderate inflation. But the fear here seems to have been that maybe the inflation will not stay moderate. And so people went into gold. This is a huge outperformance, right? 14x from one asset class to another over 10 years. But what then happened since the beginning of the 80s is an incredible drop. Just look at this. If we measure this from the 80s to basically the peak of the dot-com times, dot-com bubble, which was at the beginning of 2000, we had a 97% underperformance. 97%. So during these 20 years, it really mattered what asset class you are invested in. If you did a lot of diversification into gold because you still believed in this narrative and you didn't shift to stocks, you would have lost in relative terms basically all your money, right? You would have made so much more money by being in stocks. This really matters here. And these are the kind of trends I think people should really think about. It's those multi-year trends that really have an impact, right? If you buy stock A or B, or if you buy index fund A or B, probably doesn't matter as much. But picking the right asset class for the right point in time, for the right cycle, does matter. Now, interestingly enough, this changed, right? After the dot-com bust, we saw the gold price resurging again. By how much? Relatively speaking, by a 7x. So from 2000 to 2011. Now what happened with the S&P during that time? Burst of the dot-com bubble, right? We all know that. So the economy went in a recession. Then we had a recovery. Then we got our Lehman's crash. So basically mortgage-backed securities in the US failing. In other words, property going really down, and with it, the stock market fell as well. And so during this time period, the S&P basically went flat, right? You had these two crashes, it went flat. Property was also not doing too well simply because of this crash over here. And so the only other asset class that's left is basically precious metals, right? Of course, there's also very exotic instruments, right? You could invest in art, you could invest in old-timer cars, you could invest in all kinds of things, but the major asset classes at that time were property, stocks, and gold. And now recently we've also got crypto, right? But I explain this resurgence of gold basically from this insecurity here. The economy was not safe, even property was not safe. And so that's the kind of environment where gold was able to shine. Since 2011, we again see gold dropping. In relative terms, so far 73%. So these kind of movements, they are really massive. They really matter. So 2011, and we all know what happened since 2011, right? The S&P 500 was going through the roof, mainly because of big tech really gaining ground. Google basically building a global monopoly. So did Facebook, so did Microsoft, Amazon. They all have got global monopolies, and so they can charge high rents, high profits, and so this pushes up the general stock market. Now, when I look at this relative gold chart, right, since 71, I feel these trends are relatively clear. We're either in times of complete disaster and uncertainty, or we are in quote-unquote regular times. And to me, this doesn't look like any disaster time right now. Of course, you're following the Bitcoin strategy channel, so probably some of you might be buying Bitcoin because of that narrative of it being gold 2.0, because of it being an inflation hedge, all of those kinds of ideas, right? I personally think the main driver is adoption, right? It's not really the macro story that drives the Bitcoin price. I think it's really how well does it get adopted among the investment circles first, and then later maybe also in regular trade. That's what I think drives the price for Bitcoin. But here for gold, I don't see a real application here why this should turn around. People still invest in property. The prices are not coming down. The prices are not coming down even though Corona put quite a bit of stress on the market, right? People are not really going into the cities anymore that much, but the prices, they tend to hold up. And so you've got stocks booming, you've got property booming, you've got crypto booming. So where's really the use case for gold here? I would not try to keep holding the bag for another 50% relative loss. Of course, having some gold just as a diversifier might make sense, right? The returns are relatively lowly correlated, right? Otherwise, you wouldn't be able to get a 97% drop in relative performances. So there is a diversifying effect here, but I'm still a friend of trying to time the market somewhat. And what are we really talking about here with timing the market, right? We're talking about 20-year windows. You just need to have a view on where you see the global economies are going. You don't even have to react too quickly. You can be relatively slow. And even if you don't catch the turnarounds here, you can simply just follow the long-term trends and you should be fine. Here, for example, this is the 100-month chart on gold, right? You could, in theory, allocate in this way, simply because those waves, they are so slow and they are so prolonged. A 100-month moving average gives you a certain idea of when it might make sense to at least somewhat allocate to gold. Now is not the time, in my opinion. I don't think the younger generation, they're interested in gold. They're mainly interested just in property, stocks, and crypto. And gold is just not that attractive anymore. There's no real story like a major currency decoupling from a standard or anything like this. And so from my perspective, having anything more than 5% of your net worth in gold now doesn't make sense. I would probably even go lower than that. My personal allocation is lower than 5%. So yeah, that's, I think, the first very interesting finding. I would not go heavily on gold. Of course, no financial advice, right? We're talking about regulated instruments here. I'm just trying to make sense of the data. Another chart I find very interesting is this one here. It's the Nasdaq divided by the S&P 500. And if you're really closely looking, you might be able to spot the dot-com bubble, right? There it is. 2000, we got the crash. But how much did the tech sector relative to traditional stocks really drop? Well, 68%. And that happened in around 2.5 years. And since then, we are in an uptrend again, and tech was never as expensive relative to other stocks in the US than it was today. Now, you could have two opinions on this, right? You could say, okay, we are very highly valued right now. At some point, we might normalize again and just see another crash. don't buy tech. But I see this a little bit differently. I mean, the 90s is really where it started with mass computing, right? Where Microsoft got big and where real profits had been made. And then the internet came along and it created this incredible excitement, a similar kind of excitement that we nowadays see in crypto. But obviously we got ahead of ourselves by approximately 20 years. So it crashed down and we recovered. What I find interesting about these charts is they are really distilling the core of the trends. If you look at just the pure Nasdaq chart, the problem here with this chart is you've got all kinds of issues here. You have got inflation in here. You've got cost of capital in here. You've got all kinds of distorting factors in the point charts. But once you divide comparable asset classes by one another, there is no inflation factor or anything like this in here, right? Inflation for the S&P 500 is the same as for the Nasdaq. So you really see here what was going on between the different sectors. And my interpretation of this chart is that this is a fundamental shift of how the economy works, or at least how profits are made. Those big tech companies, they can scale globally at very low cost. Once you found a business model that works, your marginal cost of delivering another unit of service, say another streamed video or another piece of software to a new customer, your marginal cost is basically zero, right? That's very different to traditional industries where your marginal cost of, say, producing a new car is all those components, is all the labor, but there's not really a lot of additional labor to serve another customer in tech. Tech profit margins are way higher than the profit margins of any other industry. And since they can scale so quickly and attract so much money so quickly, they also tend to concentrate over time, right? We get these monopolies, and those monopolies are not anymore just within a country, but they are global. And so there is this massive power, these massive effects that are only applicable to tech that are not going to go away. These are fundamental dynamics of how the tech sector works and how the tech sector can outcompete traditional sectors. And so my take on this is, even though we are valued incredibly high, comparatively speaking, I don't see how this trend can turn around anytime. I just can't see a scenario where the competitive edge in aggregate of the tech sector would diminish, where this incredible edge, this incredibly complex business model, right? I mean, think about it. How hard is it to build a search engine that beats Google, that can give you better search queries? And if you've got this competing Google, will those two search engines really compete away the profits? Probably not, right? Because there is very little marginal cost to serving a customer. Say there would be a second Google and they both have a 50% market share. Then advertisers would just simply use both and they would adjust the bids on AdWords, AdSense, on auctioning those keywords accordingly. But just because there is a new Google doesn't mean the profit of the overall tech sector will go down. There will still be this bidding for the highest keyword, and that's dependent on how much money the bidder makes from that click. And the profit margin of Google is not dependent at all on volume, right? The marginal cost is zero. And so I think it is very wise to stay with tech. And I don't even think that, at least in relative valuations, tech is incredibly overvalued. Of course, stocks as a whole might be expensive, right? Who knows? Nobody knows. With zero interest rates, nobody knows what's expensive or what's cheap. But at least relatively speaking, would I buy Procter & Gamble or would I rather buy Google and Microsoft? I think the answer is pretty clear. I just can't come up with a scenario where this would turn around unless you completely destroy those companies, which might be somewhat happening in China right now with all the regulation that's being placed on big tech. But still, this is just a temporary thing, right? Over time, tech outperforms. It just has the superior business model. You can make more money. You can scale further and further with very little additional cost. Now there's a few more charts that I want to show you, and these are the relative performance of those leading tech stocks to the Nasdaq. So here we've got Apple, and we see Apple was falling quite a bit, right? It didn't get anywhere during the dot-com boom. Look at this 96% drop in relative terms. and then it came like Phoenix out of the ashes, a 92x outperformance. But if you just look at the recent years, right, we don't see that much of an outperformance anymore. We're basically moving in tandem with the overall Nasdaq, slightly outperforming still, but not by much anymore. We're now just talking about like 30-40%. And that makes sense. Apple is one of the largest, if not the largest, company in the world. Now with Google, a very similar story. At the beginning, we were underpriced, but nowadays we are in basically a trading range compared to the Nasdaq. Let's look at Microsoft, doing well since 2015, but also over the long term, right? We are moving more or less in line with the overall Nasdaq. Amazon also tends to outperform. So the question here really is, do you want to buy a Nasdaq ETF, or do you rather buy those large stocks directly? Because they do tend to outperform. And I think the answer to this question is dependent on how well you know those companies and how much conviction you have that Google is still going to be the leader in the sector, that Microsoft will continue to grow. And so if you want to know my personal opinion, I have picked those stocks because I own them directly. Of course, things can always turn around, right? Especially with Amazon, we don't have Jeff Bezos anymore at the top. And we do see what management changes can have in terms of impact on the stock price, right? We have a big shift here in Microsoft, but it can also all go well, as we have seen with Apple. So it's really a matter of personal preference, I think. It's both pretty valid. But what I think really makes sense is to be long technology. I don't see technology going anywhere unless politics are actively pushing against it, and I don't see this happening with the US simply because US tech is dominating all over the globe. And so America would be quite stupid to give up all this profit, all this international profit, just for some internal politics, for some internal struggles around whatever kind of laws it is, be it privacy, be it monopolistic rent seeking, whatever the idea is. I think America will continue to reap those profits. They've earned it, they've made the best products, and so the tech sector continues to flourish. Please give this video a like in case you haven't yet. YouTube will then help to show the channel to a new audience. If you haven't yet, feel free to subscribe as well. I publish 2 to 3 videos every week, sometimes about crypto, sometimes about stocks. If you made it thus far in this video, you're probably gonna like the next videos as well. And last but not least, feel free to join our Telegram channel as well. There we mainly discuss crypto topics. So if that's your thing, this is the place to go. Bitcoin Strategy channel on Telegram. See you next time. Bye bye.